Coming up today, is the stock market bounce over? I look at new tax proposals. The food industry pushes back on price controls. What's causing the US dollar's sharp fall? Job gains have been exaggerated. What could be causing a slowdown in oil demand? And what these three areas on the world map all have in common. You're going to find this one interesting, guys. Let's go. And look at that on the S&P 500. Looks like we couldn't do 9 up days in a row just after we did 8 consecutive higher daily closes. And before I get into all the usual data, news and charts, first just want to say a quick thank you to all my viewers on YouTube. The Click Capital channel just passed 10,000 subscribers last night, and I started this channel early last year. I never would have thought it could grow this fast. So a big thank you to all of you who have subscribed to this channel and continue to support it every day by hitting that like button. Okay, so let's dive right into the daily market review. Market color still really green across the board. However, when things are pretty much perfect, typically only leaves one other direction it can go, right? The only difference between today and yesterday is energy sector has gone red across the board, as we just had another fall in crude oil. And stick with me today because I'll come back and take a look at the commodity market later on in this video. Just performing a bit of technical analysis on the S&P 500. We're clearly a little stretched and technically overbought here. Even though we're not overbought on my S&P 500 oscillator, we could be setting up a little bit of a bearish divergence here between my oscillator and the price of the S&P. And just going to my main technical chart, looking at the S&P 500 ETF, did just fire off the first reversal signal today in a similar zone to where they last fired off mid last month. And I think we can safely draw a resistance box up there where price last turned. And so we potentially could be setting up a double top formation in the market. And the reason why that's possible is a few different indicators out there that I'm noticing today. The first being the percentage of stocks above the 20-day average potentially looks to have peaked out in similar levels where we've previously seen short-term market tops. Net new 52-week highs. It's definitely not breaking out on the market here, back to where we were last month. Even no new lows haven't broken down. One thing that's really caught my eye today is the really low put to call ratio. And that may have peaked out today as well. Really lopsided. 59% calls, 41% puts. So people have just been chasing this recent price action, loading into call options here. And we did see a little bit of a bump up in the VIX index today. Volatility still moving around, up 8% today. Still relatively calm for now though, with the VIX term structure still in contango. There's a few other things I'm watching in the market that's got me thinking we may have a pullback. First being the government bond 10-year yield. This 380 support zone, something I've been watching for a few weeks now. And even though normally lower bond yields are good for stocks, you don't want them to get created, especially on the long end. That's the market forecasting a weaker economic environment in the future. And so I'm still looking for this 380 level to be defended on the US government bond 10-year yield. Getting a few reversal signals on high yield bonds as well. Had a pretty good bounce back from the 5th of August. And stick with me because shortly I'll dive into some of the things that's been reported as to why the US dollar could be coming off hard here and the implications for that. Another thing I'm watching for signs of future economic weakness is the price of crude oil, which does correlate with consumer demand, especially out of big economies like America, China. That too sitting at a support level like the 10-year yield. $73 a barrel. If the market were to break through that, we were to trade down into the 60s, that would be the market saying it forecasts weaker demand ahead as the consumption of oil is correlated with economic activity. And we still have the economically sensitive commodity of copper in a bit of a short-term trend here, and high beta stocks versus low volatility stocks, really sensitive to risk sediment, weren't able to reclaim their 50-day average today. Counteracting those bearish points, which are more in the short term, is looking at S&P forward returns when the consecutive number of days we're up is more than 8, which we just did. Looking back at data from the early 1950s, going forward a year, we're positive 69% of the time. However, just looking 5 days out, we're only positive 44% of the time, and 10 days and 21 days out, we're positive 60% of the time. So it can be a bit muddy in the short term after we have such a good winning streak, and especially going into Jackson Hole this Friday. Market may want to take a few chips off the table. If Jay Powell doesn't come out as dovish as we're all hoping, that could cause a sharp 2-3% down day. If for some reason US government 10-year bond yield and crude oil falls through support, that could be those markets signaling economic weakness, which the stock market may react to. And we've just done another record in this bounce back. In addition to the record VIX crush, sharpest ever crash in the VIX index, we also just got the fastest 10% rally from a correction low ever. A correction said to be when an index comes off 10% or more from its high, but less than 20%. Which is the definition for a bear market. And so just looking back in history at the number of trading days for the Nasdaq to rally 10% from its correction low, on average it's about 32 days, and sometimes even take 70 more days. We just did it in 8. And we always see charts of the dollar amount of corporate buyback, companies buying back their own stock, a real big driver of stock prices over time. In dollar amounts, however, this chart shows it as a percentage of the S&P 500's market cap, which I think is a more accurate visualization, and that's actually hitting record highs for this year. So that's the supply of shares out in the market has been reduced more than ever, and inflows into the market still really elevated. Pensions all around the world continually pouring money into the market every single day. And here's a cool visualization of market breadth showing the top 10 stocks in the black line and the bottom 490 stocks in the S&P 500 here in the purple line. And the shaded areas representing the percentage of stocks above or below the long-term 200-day moving average. Blue's good, white's in the middle, red is bad, and we can see that in late 2021. There's a divergence between the bottom 490 stocks and the top 10, and market breadth started flickering red as well. 2022 was a bear market, and last year we didn't have the best market breadth as well. That was causing a lot of people to think it was just a mega cap tech 7 rally and the recession was still on our doorstep. However, that narrative kind of faded away in late 2023, and overall long-term market breadth has been pretty good. As we can see, it's shaded in the blue ever since then. And just looking at the average presidential cycle from year 1, midterm, year 3, year 4, then the following year 1. Seasonality here in the shaded blue. With S&P 500 in the black bars from January 2021 to right where we are now. Again, remarkably close correlation between normal seasonality and the path we've followed. And if we continue following that path, that would suggest that we rally towards the end of the year, and then the first half of next year we could pull back, and that's what I'd be expecting as well, as a lot of government stimulus may start getting wound down. Once the election is over and we've had a pretty good run this year and last, wouldn't be surprising to see the market take a bit of a breather for a quarter or two before finding its footing, and I'm sure we'll get a surprise or two in there as well. But so far this year, it's been one of the best election years ever. Looking at S&P 500 performance year to date, looking at this chart, appears to be only one year that was currently performing better than where we are right now. So again, wouldn't be surprising to see a bit of a pullback over the next week or two, and we could still consolidate going into September and October as well. And just looking at VIX seasonality, typically see the biggest readings in August, which I'm sure we did on the 5th. However, we can still see elevated volatility in September and October as well, before things normally quiet down going into the holiday period. And so the big event this week is Jackson Hole, Jay Powell, his language on Friday morning. Then the big one after that will be next week, Nvidia's earning. We've already seen them slap on a huge $765 billion in its market cap value in just the last 2 weeks alone on its bounce back. Truly insane numbers. And the expectations are rosy. Why shouldn't they be? All these big companies can't get enough of their GPUs, kind of like an arms race. Who can have the most compute power, not to mention militaries around the world trying to get their hands on them as well. And so the big test for financial markets, not only in the US, but this is going to have ripple effects on global financial markets, as they can quite often do, is the US presidential election a little over 2 months from now. And so again, it wouldn't be surprising to see another spike in volatility before then. Who knows what could happen this time? Been quite a diabolical lead up just until this point. And according to UBS, they've done some analysis, came up with some possible scenarios and how it could affect markets. They actually have got Kamala Harris as the favorite to win, like we've been seeing in polls and in some betting markets as well. Although they forecast a split Congress, they say in that scenario, it would be slightly negative for stocks, while a Republican win would be initially positive. And looking at the price action of markets lately, kind of been tracking a little bit on the odds of who's going to win. We had that big bump up with Trump, along with small caps, domestic companies and Bitcoin. Now we've seen the bump up with Harris, kind of that trade winding back a bit. But we've also been seeing some pretty big moves in currency and commodity markets as well. They think if Trump gets a red sweep across the board, which they put at 35% odds, I'd say similar to his first term, looser regulations, concerns for tariffs. On the other hand, if they think Harris comes through with a blue sweep, which they see as a 15% chance, in that scenario they see it as being the worst for stocks, tighter regulation and tax increases, with the lowest chance they think a Trump win and divided Congress, which would pretty much be mixed impact on stocks, and of course less regulatory pressure on fossil fuels and the financial sector. However, another thing the stock market could get worried about is the Democratic Party's call for a 44.6% capital tax rate, which would be the highest ever since this tax first creation over 100 years ago. Something Biden proposed back in April. However, I've just heard Harris come out and support that, as we're starting to get a bit of clarity on what her policies and positions could be. And so in addition to a bigger capital gains tax, not just on realized gains, but also talking about taxing unrealized gains as well, which would majorly affect the wealthy and the rich. That could affect the overall stock market and affect all of us investors, small and large, if some of the biggest holders of stock have to sell to pay a yearly unrealized gains tax bill. On top of that, the current administration would like to quadruple the stock buyback tax to 4%, to discourage stock buybacks. And again, that would have a material effect on the stock market as well. Like I said before, stock buybacks are a big driver for stock prices over time. You can just look at the chart of Apple's revenue growth versus its stock price growth. Stock price has gone up multiples of what their revenue has, and that's thanks largely to stock buybacks. That's really what's helped make the US stock market so big, so that could have a material effect on it as well, which again affects all of us who participate in the stock market. We've got some media out there, like the Independent Women's Forum, liking Harris's economic plan to being inspired of that from Venezuela, with them saying her policies could accelerate inflation, spike house prices, lead to shortages, reduce innovation, discourage interest rate cuts, and complicate the already existing tax cuts. And so something we've been hearing about is a proposal of stepped up price controls on food companies. And unfortunately, that is a classic sign of socialism. The state trying to once again intervene into free markets and tell companies how much to charge for their products goes against all the principles of free market capitalism. And it actually showed up in my own social media feed this morning. Senator Elizabeth Warren said, "Have you noticed that groceries cost a lot more than they did a few years ago?" And this has happened worldwide, not just in the States. Food's gone up around the world. But she went on to say, "You're not the only one. Massive food corporations have kept prices up nationwide to exploit consumers and make a profit. It's time to bring them down." And so I'm hearing a lot of people talk about this, and millennials as well. I think they get confused on how inflation actually comes about and whether it is corporate price gouging that are responsible for these high prices. However, the fact is, when you look at the data of the gross margin of the largest US food producers across the whole industry, currently at 34.5%, which is pretty much the same level where we were when COVID started. And in fact, it's easy to see the trend on this graph, which is over the last 16 years to 2008, is clearly down. Lower highs, lower lows. So the argument that your local grocery store is price gouging, and that's the reason for high prices, just isn't simply backed up by the hard data. And so it's no surprise the food industry is pushing back on this narrative. Companies rejecting claims that consumers are being bilked, with them pointing to the facts that increased costs in labor, the difficulty in finding labor, the increased cost of raw materials, not to mention over a quarter of all US dollars in existence were created in the last 4 years, huge increase in M2 money supply. Those are the reasons why food prices, along with many other products and services, have gone up in the last 4 years. It's not because all your local grocery stores have got together in closed-door meetings and all agreed to increase their prices. But no doubt, these high food prices are hurting a lot of consumers out there, so it's seen as low-hanging political fruit. The real question people should be asking is, how does someone on a $285,000 salary get a net worth of $67 million? However, we won't get into that, but CEOs are worried about this as well. There's been more mentions of the election and Q2 earnings calls than what we've seen in the past of other Q2 election years. But all this stuff does affect us, not only as consumers, but as investors. Seen a sharp fall in the US dollar. Kind of hard to believe I'm sitting here in 2024 talking about potential socialist policies in the United States of America. Looking back in history, whenever a government leans more towards the socialist side, typically devalues the currency because they create more inflation. They increase taxes, which makes the government more bigger, and the government's the worst allocator of capital. The bigger the government, the more inefficient the society. You want to leave most of the capital in the private sector, where there's the incentive of profit or the punishment from competition, much better at handling capital and its allocation. And so I know a lot of you guys watching, both Americans and those around the world, really hope the United States doesn't go down this rabbit hole towards socialism. We don't want to see the US dollar collapse. And again, you don't have to believe me, you can just look at the data. And this chart I've got here is a perfect example. Back in the late 90s, Poland and Estonia, socialist-run governments and economies, flipped over to capitalist governments, freed up the economy, reduced taxes. And it's amazing how much a country and economy can turn around, both up and down, with the right policies. You can see GDP per person has exploded. The prosperity of the country and everyone in it is at all-time highs. On the other hand, Argentina and Venezuela used to be some of the strongest economies for decades. Throughout the 20th century, they went the other way. They got rid of their capitalist governments and economies, and they went to socialism. And just as this chart shows, that made the country and everybody in it poorer off as a result. Really sad to see what's happened with Venezuela. They've got more oil reserves than any other country in the world, and they haven't been able to turn that into their own benefit. But it can be turned around, just like Milei is doing with Argentina. And would you believe it? Ever since he was voted into office, not only has he brought down inflation for his countrymen, turning the economy around, making a smaller government, getting rid of corruption. Argentina is also the best performing stock market since then as well, up 50%. And so financial markets do key off governments, as governments are the biggest forces in markets. The rest of us play by free market rules. They can intervene at will. And so not only have we seen the US dollar come off sharply of late, we're also seeing emerging market currencies as a basket breaking out and hitting highs. And so that implies a few things. That's the market getting more bearish on the US economy relative to these emerging market economies, and that can be favorable for emerging market stocks and commodities as well, just like we saw back in the early 2000s, big bull market and emerging markets and commodities. And so investors, one way to play this is diversify out of US currency and US stocks, and you can do that by investing in foreign stocks, or you can get a US dollar priced American Depository Receipt, ADR, that trades in New York, which lists some really good commodity related companies, especially out of Brazil. Not too hard to find low PE, high dividend yield, commodity related stocks coming out of these emerging markets. And so all these recent moves are prompting me to further diversify my portfolio into some of these markets, and it's starting to look like we're getting the wind at our backs here. But just getting back to the States and looking at the jobs market, which really started spooking markets a couple of weeks ago, going into that VIX 65 event, was the bump up in the unemployment rate at 4.3%. We did see jobless claims coming better than expected last week. Be looking for the same tomorrow. However, the government keeps revising their numbers down, and this one looks like to be a doozy. The government's going to do their benchmark revisions for the increase in US employment from April 2023 to March 2024, and their estimates are that could be anywhere from 600,000 up to 1 million. They could have overstated job growth by 1 million. That's not really a small miss, and these revisions are controversial. Kind of allows the government to play around with the headline print that mainstream media runs with, and then the revisions are kind of just pushed to the side and don't really get much attention. And so this could play into Jay Powell's thinking as well. I'm going to be really interested to hear exactly what he says this Friday morning on a number of issues. This one included, no doubt he'll be talking about the jobs market, the softening we've seen over the last month or two, along with inflation getting down to a 2-handle, central banks around the world starting to cut, some other signs of softening in the economy. But the big one is the jobs market. Jobs and inflation, two big data points in economics and markets. We are seeing an uptick in the amount of US workers that are expecting to become unemployed in the next 4 months, currently at 4.39%. It's broken out to a 10-year high. We also just saw 28% of Americans searched for a job in the last 4 weeks. Again, that's the highest in 10 years as well. A lot of people worried about their job security, maybe not liking what they see right in front of them. However, counteracting that a bit is the amount of job openings per unemployed person, still sitting above 1. Previous recessions, that was well below 1, about 0.7, 0.9. Less job openings than unemployed people. So the jobs market is still okay. However, we could be trending in the wrong direction. But we are getting mixed signals. Like we can see this summary of Q2 earnings season comments from a variety of different companies. Citigroup, they continue to see overall resilient US consumer. MasterCard the same. Pepsi said the consumer is more cautious, more choiceful. Amazon said consumers being careful with their spend, trading down, lower priced products. And Visa saying things are relatively stable, but slight moderation in the lower spend consumer, which is kind of what McDonald's said as well, pointing at the low income consumer as being under a bit of pressure. And that's the case in the economy. The top 10% are still fine, still spending, but the bottom 50% are struggling with high rates and high inflation and stagnating price wage growth. And that's why the headlines of food price controls has got to sound appealing to them. Another interesting chart today from Bank of America showing the stark difference between the cumulative inflow into treasury since 2018, up the top here in the dark blue, T-bills, treasury bills, bonds expiring in less than 1 year. In the light blue, treasury notes, bonds that expire between 2 and 10 years. Down the bottom, T-bonds, long-dated bonds. The last 6 years, the cumulative inflow, $2 billion versus $71 billion for T-bills. Pretty much where Warren Buffett keeps the vast majority of his liquidity as well. Big money simply doesn't want to own long-duration debt here, because we can all see the exploding US government debt, not only affecting the credit quality and risk of lending to the US government, but also future inflation, money supply, long-dated rates, likely to stay elevated, and that's a headwind for owning long-dated bonds as well, where short-term rates are likely to come down and you don't have as much interest rate risk with shorter-dated bonds either. So moving on to the commodity market, even though we've got the US dollar diving, which is definitely likely given a tailwind to gold, it certainly is not for crude oil. Trading really heavy now, bottom end of its range at support, even though we still have elevated geopolitical tensions all around the world coming out of major oil producing regions. The market could be worried about consumer demand around the corner. An interesting article I saw today, China's electric vehicles are fueling a big oil demand slowdown. That could make a little bit of sense. We have seen an explosion in the production of EVs coming out of China, trying to flood the global market with cheap EVs. Definitely affected Tesla. US government's trying to push back on that. But according to this research, it's reduced oil demand already by about 500,000 barrels a day. And this is at a time when China's economy is still quite soft. Another interesting piece today, we're starting to see negative energy prices becoming more common in Europe. Many countries over there get a lot of their electricity from solar and wind, which has had some strong generation recently, causing prices to fall below zero. And always nice as a consumer of electricity when you actually get a rebate and credit from your power company. However, there's still a long way to go with being able to store that energy. And that's another area I think Tesla may surprise a lot of people, as they're a leader in battery storage. And parts of Europe did technically go into a recession late last year. However, just looking at their growth in Q2 versus Q4, most of them are in the green and above 0.5%. There's UK at about 1.3, leading the pack Poland. They're doing a lot of things right, and that's resulting in great economic growth for them. Also be interesting to see price action of gold around Jay Powell's speech as well. Had a pretty good run lately. Shouldn't be surprised to see a bit of a pullback. However, like I said, what's going on with the US dollar? The market's worries there. Potential for an even bigger US government with more tax, more government spending. That's all bullish for gold. And who knows, maybe one day we'll look back at $3,000 an ounce as actually being cheap. And we've now got the classic gold bar worth more than $1 million a piece for the first time ever. It's about 400 ounces. Also got Bitcoin waking up a little bit, trading back above 61,000. And again, a weak US dollar. Just another tailwind. For all assets priced in the dollar, especially those with finite supply, like gold and digital gold, Bitcoin. And as promised at the start of this video, I'm going to share with you guys the significance of these three areas on this global map. I know it's a little blurry. However, what you're looking at is the eastern side of the United States, from Texas, Florida, all the way up to New York. It's where the vast majority of Americans live. Then over here we've got the UK, bit of Italy, Spain, Germany, France. Then over here we've got the eastern side of China, Japan, and South Korea. And just these three areas on the map here make up over 50% of the world's GDP. That is, over 50% of all products and services sold in the world come from these three areas. And just goes to show you how concentrated economic activity in the world actually is. And not much to report from the economic calendar today. Canada's inflation rate pretty much coming in line as expected, with the headline year-over-year 2.5%, and a little bit softer on the core rate, which is another good sign for inflation in Western economies. Then looking out tomorrow, FOMC minutes, crude and gas inventories. Then Jackson Hole's going to be kicking off with PMIs from Europe and the States Thursday, then Friday morning. This is the one we're all waiting for, so we can work out whether Jay Powell's going to cut rates next month or not, which the market's assigning a 100% chance that he will. They're just giving 2/3 chance he's going to go 25 basis points and a third chance he's going to go 50. And we'll see how these odds change after we hear from Jay as well. I'm also looking at agricultural commodities today, starting to perk up a little bit here. May have found a little bit of a bottom and holding on to this nice uptrend. Kicked off from the start of the year, and we're starting to get a lot of dispersion in the market again. Just looking at the 5-day performance of different stock sectors, there's technology leading up the front, 4.6%, along with discretionary. Down the bottom, energy and REITs. Same deal, looking at a 5-day relative performance chart of major markets, leading silver, the Nasdaq, SP, and gold. Down the bottom, oil, Bitcoin, commodities as a whole, and the dollar index. Weaker sector today definitely was energy, finishing down 2.6%. Did see gold miners just break out to a new yearly high, along with healthcare stocks, consumer staple, and REITs pretty much sitting at highs as well. And pretty sharp fall, big energy companies, ExxonMobil, finishing down 3.3% today. Pretty weak here for energy. And like I said, this really sharp V-shaped bounce back in the market, maybe stopping to catch its breath here, pause for a moment, consolidate like we often see around new all-time highs, and then just wait and see what Jay says, and that could set the tone. If he indicates he's going to go big with a 50 basis point cut, or at least the market thinks that, we could see a big rip to new all-time highs. However, if he came out even slightly hawkish, I'd say that could upset the market again, and we could be back below the 50-day VWAP before we know it. And like I said, I'll also be watching the 10-year government yield to find support, along with oil as well. If they both lose support, that could be markets indicating potential economic weakness around the corner. And let's just hope this US dollar sell-off doesn't turn into a full panic either after what we just went through with the Japanese yen. Thank you all for tuning in to me today, and I look forward to making you another video tomorrow. Cheers.